Okay.
For some thoughts.
So it's Trevor Smith. I'm here with Dave Colarchik, who is the, what's your title, Dave?
I think I'm officially branch manager.
Branch manager. And what's your company name?
Cardinal Financial.
Okay. And so Dave's a very knowledgeable lender that I've used personally, and we used him with a lot of clients. But in this uncertain time, I wanted to interview you and just get your take on where we are with things, because we're in an uncertain world, both from the COVID virus and maybe even government funding of loans, the uncertainty that exists in the lending world. You and I have been talking about this for the last few days, but give me your perspective. Where are we right now? What, I know we don't have jumbos, or we have limited access to jumbos right now. Tell us, what the realtors would want to know, and maybe what the public would want to know.
Yeah, well, I'd say we're kind of in uncharted territories. I mean, rates have been swinging all over the place, kind of unprecedentedly. There were some days a few weeks ago when rates would literally, I'd look at someone at 3.375 in the morning, and by 4 o'clock in the afternoon, it was 4.5. That was as the market was kind of changing. And basically the investors, the mortgage bonds are typically bought like stocks through investment pools called mortgage-backed securities and whatnot. And that kind of dried up. And so that was just causing this drastic fluctuation in interest rates and just this incredible uncertainty in the market. And then the Fed stepped in, and the Fed's basically come up with what they're calling a QE Unlimited. So if you remember back in the mortgage crisis, there was QE1 and QE2 and multiple quantitative easings. And that's basically the Fed has unlimited amounts of money, literally. They can print money till infinity. And so the Fed right now is buying, they're buying specific amounts of mortgage-backed securities, keeping the market liquid. So kind of through this process is this giant readjustment process for all lenders. And there's a lot of risk on top of that. Let's look at jumbo loans. For example, Wells Fargo announced, it was in Wall Street Journal a couple of days ago, that they basically weren't going to do refinances for any jumbo clients, unless they had $250,000 in the bank with Wells Fargo. And that was a Wells Fargo issue still left over from their penalties from their, the issues they had with the public. But jumbo lending kind of in our mortgage banking world has dried up. Because we do jumbo loans, we fund them in our own name, and we sell them to Wells, we sell them to Chase, we sell them to Redwood. Well, Redwood's not buying loans. Several of the investors that we sold to just simply aren't buying jumbo loans because the market is illiquid. It's so uncertain, and bond investors don't like uncertainty. And no one wants to do a 80% finance on a $1 million loan that all of a sudden the value goes down 20% and it's 100% financing. So that's basically just dried up for us. So there is jumbo financing, but it's at your money center banks, your Wells Fargo's, your U.S. banks, all of those guys. And you just would expect really slow service right now, just because they're going to be overwhelmed because they're the only ones doing loans.
And this is only for their clients too, right?
No, they'll do it for anybody.
Okay.
Yeah, and what else? There are companies like mine that are doing loans. So our world is what we call the mortgage banking world. So I mean, even to a degree, Quicken Loans is a mortgage banker, right? There's some companies, unlike ours, we just said, hey, we're not doing jumbo loans for the time being. There's some companies that say, hey, we'll do them. But what they've done is they've basically raised their rates and their pricing. So they're just so far out of market. In reality, they're not doing them. So really, if you're in the jumbo market, you need to be looking at a money center bank for that product. Generally speaking, there could be some exceptions to that rule. And the alternative is, if you're in the $800,000 range, you could look at, a conforming loan, first, second combo just to get in, and then, refinance later on down the road into a jumbo loan.
And what's our conforming limit for Washoe County?
510, 400, I believe. Yeah.
Yeah. So for the normal person buying in our market, that's not even, I mean, it's relevant, but it doesn't matter.
Yeah, or in our parts, a normal person might have 3 or 4 houses. You do a combination of cash out refinances and various other strategies that we try to be creative with, of course.
So the disparity between the conforming 30-year fixed rate and whatever you're calling the quote unquote, we don't want to do a loan jumbo rate. What's the differential right now?
Well, that's going to be high. It's not even worthy of looking at. But the conforming rates, at least right now, the Fed's kind of stepped in and kept liquidity in our market. We're looking at I'd say mid to low 3s right now.
Okay, so that's attractive.
Yeah, no, it's the conforming loans are really attractive, and the refinances are really good, for sure. The one thing I was thinking about today, though, is those people that haven't refinanced or haven't thought about it, or even in the purchase market coming up soon, appraisals, I think, the clock's ticking on how long we're going to start having issues with appraisals. Now, right now, for a lot of conforming loans, we're getting appraisal waivers, so we don't have to do them. So that's like Fannie Mae's version of Zillow. They do analytics and say, we don't need an appraisal. But at some point in our market, when we don't start having a lot of comps, how's an appraiser going to be able to do an appraisal without comps? And things have obviously have slowed down, as you know. But at some point, that could be an issue coming up, which should be a concern, just from a lending perspective and something to be aware of from a realtor perspective.
Let me get your perspective too on the other one that I saw on CNBC was the mortgage servicers, potentially going under because they're making payments to the investors. And you've got these forbearances coming through that are either automatic or you just ask and you can get it.
Yeah, no, that's super. That's another problem with our industry. So part of the whole pricing into a loan, it's basically just a bond, but there's servicing rights and all these other things that get sold off that kind of work into the overall food chain from a compensation perspective. But companies that service loans. So for us, we service some of our loans. We sell some of our loans off. You've probably heard of Mr. Cooper. I think they're the largest servicer. Well, their covenants or their contracts, so they have to pay the bondholders on the loans that they get. But if the government says, hey, you get to forbear payments to the borrowers, then the servicer still have to make payments to the bondholders, yet they're not receiving payments from the borrowers. So they have to have huge amounts of cash to be able to make those payments. And it's my understanding, part of the CARES Act did not include relief for these independent mortgage servicers. And so I thought I read yesterday, but it was an article, or was it this morning, that wasn't crystal clear on whether the Fed decided to provide that they need some sort of short-term credit facility to these companies so they can basically float all these people that aren't making their payments. Which is another thing too, as a realtor, if you do have a conforming loan, a Fannie Freddie loan, you can literally go on their website or call the servicer and get your payments. Just skip your payments. Just turn off your payments for a few months. It's with allegedly no penalties. So that's one thing I'd be cautious. I've talked to a few clients about it. If you have the money and it's not a problem, I would be inclined to make the payments. Don't take the free money. Because, these servicers and stuff, I don't trust these big companies, and they say that it's not supposed to impact your credit. But if for some reason, they report you 30 days late or tell you you're not making payments, and then 6 months or 9 months, you got to buy a house, you have a bunch of things on your credit report, it could create, hell for you. And it's probably not going to be worth it. Even though the servicer was in the wrong, it's going to screw you for buying a house.
Right, you still have to fight with them.
Yeah, and you can't trust these companies. I mean, some of these companies are horrible, as I think you may have personally experienced.
Well, yeah.
That's another subject.
We reached out to Mark Amadei's office, and they are helping us with this issue you're talking about, creating that funding. So they're aware of it. Treasury's aware of it. I've done a fair amount of research on it, and not that I know it like you do, but it's a huge problem. It could be, it could collapse the servicing industry.
Which would be huge. I
in
mean, Quicken Loans
or 60 days or whatever. Yeah.
Yeah. So I find it unlikely that they're going to let that happen, because that's just huge. So, but you never know. They might cause them to file Chapter 11 and reorganize, or it just seems like the Fed, right? I think I don't know that the Fed has the legal ability to do it. So it might need to be a congressional act that allows the Fed or somebody to actually provide that relief, which obviously could take a while, right?
Well, and that's the other thing that Amadei's office did say, that it was originally part of the CARES Act, and then for some reason came out, who knows why, but
we had to fund the Kennedy Center.
Exactly. Yeah. So, I mean, who knows, but it's a full circle, right? If you don't complete the circle, whatever link you left out is potentially a failure. So that was part of what I was talking to you about. I mean, I think that's a major issue, and it could be this uncertainty that you're talking about is basically, until we lock all this down, we're not going to have the ability for purchases anyway to get a jumbo loan in any real fashion.
Well, what do you mean?
Well, I mean, so for example, I had a deal that fell apart this last week that was exactly that, right? It was call it a $900,000 loan. They said, well, we'll approve you for half of that if you pay off your other $900,000 loan on this other property. So it's like, okay, well, effectively no loan, right?
Yeah.
So, I mean, you got approved, but you didn't get approved for what you were asking for. And I've never seen that. I mean, this is like really unprecedented as far as I'm concerned.
Yeah, I mean, you're going to be subject to the big banks, whatever they decide to do. So I would imagine there's any pressure on them to lend, but you never know. It might be more in the lower market, because that's, they tend to want to help the underprivileged, for lack of a better word, I guess.
Right.
So, and
let me get your perspective on all of the stuff from the CARES Act. Is there, what are your thoughts on it? I mean, obviously there's a lot of realtors that are going to see this. I'm telling them, apply for everything you can, see what you can get. And, worst case is you give the money back if you have to, but, who knows how long this is going to go? Do you have any comments on that? Thoughts?
I haven't read much about it. I think that people that are having a hard, that don't have a lot of cash right now, if you have the opportunity to forbear your mortgage, you absolutely should. If you need it, you should. Again, I'm with you. I'm in the same space. I mean, I'm sitting, I'm just reading article after article after article from Fed chairman to economists to things right now, and I don't see, I'm having a hard time seeing, any sort of rosy outlook. I mean, JP Morgan Chase just predicted 40% decline in GDP for the fourth quarter. They raised it from 20%. I mean, our GDP, I believe, is like, somewhere maybe, I'm trying to, I looked it up the other day, but it was like, $20 trillion, but that was like 2018, I think. So let's just say it's $24 trillion. So 40% of, let's say, 20 trillion, that's $8 trillion. And I mean, the numbers are just staggering. So, I say save cash, save as much cash. Cash is going to be king. If you have a HELOC, I had someone close to me who was, hey, Dave, should I take money on my HELOC? I have enough money to get by for a few months. And I said, yeah, take every cent out. You're going to pay some interest on it. It might cost you, and if you don't need it in 3 or 4 months, you just put it back, right? But get it while you can, because just like in the days of the mortgage crisis, when people finally went to draw on their HELOCs when they need them, they weren't there. So I'd say apply for everything. Forbear your mortgage if you're not sure. If you only have a couple months, because like you said, Trevor, this thing could. I'll be shocked if it's not anywhere, if it's not near as bad, if not worse than the 08-09 deal. I mean, you just start throwing in all the other factors. It snowballs. It's mind-boggling. Why they're not talking about it on TV, I have no idea.
Yeah, well, CNBC is talking about the mortgage servicers for sure, but yeah, and I don't know too. I mean, in my mind, there's you make the payments, even if you've gotten a forbearance, who cares? Make the payments if you can, and you pay down the principal. And you know, like you said, who knows if nobody trusts anyone. I think that's the difference this time, right? Everybody's saying, well, yeah, okay, the creditor could report me with a derogatory on my credit report, and then I have to go back and spend all this time trying to fix it, or maybe they'll do it the way they're supposed to, but I don't trust anyone.
Yeah, but I mean, if you don't have 6 or 12 months reserves to live on, you know, I think you throw that to the wind and hope the right things happen and save your cash for now. Because I mean, if this thing goes the way I mean, come on, the entire world economy stops. To think this is going to be over, it's just common sense, is going to be over in 2-3 months without repercussions.
Yeah.
I mean, no, I mean, the Fed chairman from the Dallas Fed chairman, I don't know, but he said something along the lines of, you know, expecting a 2-year recession. I mean, that's going to hurt everybody. So having cash, you know, to help supplement your daily needs is just going to be huge. Because when you need to borrow money is when you can't get it.
Right.
You know, so
absolutely,
really huge. You know, and back to lenders, the other component that it's affecting is a lot of small lenders, like so there's small mortgage bankers like us that now don't have, you know, even access to loans, and even mortgage brokers. I just looked up today, you know, when we were a mortgage broker, there's the company that was always the lowest rate leader in the mortgage broker space. I looked at their rates today and I was like, holy crud, they're like way higher than us. They're like, so they're out of the market. So it's affecting a lot of, you know, there's still not a lot of mortgage brokers like there were back in the day, but they were starting to pop up again. But those guys are, you know, really going to face tough times as well.
Well, thank you, Dave. I appreciate it. Do you have any final thoughts? I don't know. We covered a lot. So
now, if you have a HELOC and you're going to need money, take it now, pay it back if we don't need it. Take advantage of the no payments if you can. I agree with you. If you have a business or you have any way of taking care of some of the business relief funds, stockpile cash. If you don't need it, you can pay it back. But you know, we don't know where this thing's going to end up. I'd say so. Be conservative, you know, as much as you can.
Well, thanks, Dave. So we'll have Dave's. Yeah, you too. We'll have Dave's complete contact, company info, and website in the comments below. And I thank you for your time, Dave. And it's really valuable to get your perspective. And I think a lot of people are going to benefit from this. And
no, I guess suppose one other thing, if you are in the conforming space, whether you deal with me or anybody else, if you're, you know, much above 3.5 on it, you know, just a primary loan or whatnot, you need to evaluate a refinance, because if you wait too long, again, we're gonna have those appraisal issues, I'd say, in the next probably 90 days or so.
Awesome.
So
well, thank you, Dave. I appreciate it. Take
Thanks,
care.
sir.
Thanks for your time.
Anytime. Bye.